what is stagflation? So it's a combination of two things. So high inflation and stagnation of the economy. These two things are bad for the economy. They create the negative effect on the markets.
What are some tips that you can give to some traders when we are in this stagflating environment?
In this case, macroeconomics or the economic releases and the behavior of the markets is disrupted a little bit.
The question is, are we in this stage? Are we stagflating right now? Hello and welcome back to our weekly episode of Exness Trading Talks. Last week we discussed 1 year into Trump's second term, tariffs and how various policies affect fundamentals like US growth, inflation and jobs. Now for this week we are going to talk about stagflation, where it originated from, how to recognize it in modern markets, and a comparison between oil, inflation and GDP. If you haven't done so already, you can subscribe to our channel and turn on notifications to be first to know when the next episode of Trading Talks is going to be released. Today we have Stanislav Bernukhov to share his views. Hello Stan, and thanks for joining us.
Hello Andreas, thank you for having me.
Okay, so let's begin with, first of all, we hear stagflation. Is it a combination of two words, something like inflation? So how it originated and what's the origins of this?
So basically, what is stagflation? So it's a combination of two things. So high inflation and stagnation of the economy. So basically all these two things are bad for the economy. So they create the negative effect on the markets. And it is a disruption of the, I would say, the conventional monetary policy when, for example, you cannot raise the interest rate because otherwise you will provoke problems with jobs, and you cannot lower the interest rate because you provoke inflation. So central banks kind of are caught between these two negative alternatives. So that's basically a stagflation.
Okay, so what, in your view, was, let's say, oil the trigger of the whole situation, or just the spark that exposed like deeper structural problems?
You mean the situation with the UK in 70s?
Yes, the origins of that.
Yeah, so long story short, in 70s and the beginning of the year, so the UK was facing the same problem with stagflation. It's called the Barber effect, the three-day week, so-called, the crisis of the British pound. So they started to try to, boost the economy by lowering the interest rate, by making the affordable credit. And basically they provoked the inflation. So that's what they did. After that, the oil spike actually triggered the situation. That was a trigger because there was a lot of structural problems in the economy in the UK back then. So I cannot say that the oil was the reason for that, but it rather was a trigger.
Yeah, more triggering the domino effect rather than being the main reason behind it. Okay, and in your opinion, what kind of policy mistakes made, let's say, things worse? Was it rate cuts or spending, wage controls, anything? In your opinion, what was like the thing that made things worse?
Well, it's difficult to say what they did bad necessarily, because they did what was in the textbooks, basically. They lowered the interest rate, they tried to boost the economy, but they raised the inflation spike. Now, for example, nowadays, central banks are very cautious in lowering the interest rates because they are afraid of this scenario, basically, because inflation might be out of control because of that. So there are vivid examples from the past, from the UK. Not only that, but in Japan, there was stagflation, 1973-78.
Yeah.
Also, there was a great inflation in the United States, also in 60s. And the reason was different. It was military spending in Vietnam, for example. But all those, overspending or making affordable credit, lower interest rates, so that might cause this effect. And governments try to not make these mistakes in nowadays. For example, the Fed was very reluctant to lower the interest rate.
Yeah.
They were viewing the data. We need more data and more data. So that mantra
Yeah.
made by Jerome Powell actually makes sense because they rely on those cases from the past.
Yeah, we need more data is like the catchphrase of the Fed nowadays.
We need more data.
Yeah.
Exactly.
So how do you recognize stagflation? How do you define if we have like a supply shock or if we have like excess demand or...
Well, there are two situations. For example, excess demand and when the economy is overheated. So jobs are very high, so they're going up. The credit is developing, so corporate margin is pretty high, and that pushes prices higher. So inflation in this case is the outcome of the overheated economy. So it's at the end of the cycle. Supply shock is a different thing. So that means that supply is moving down, but prices are going up because of the deficit, because of the disruption of logistics, sanctions, any other disruptions. So in this case, economy is, slowing down, but inflation is not bouncing. It's not bouncing in this situation. So it still goes up. So that's the worst situation because prices are high, but the economy is slowing down. So that's called stagflation, basically.
So speaking about how to recognize stagflation, I would urge you to click on the link in the description to read the article with more details on how stagflation originated and how it affects today's markets. You can also click on the link to sign up to our newsletter to receive weekly updates on the markets in general. Okay, so is there like a lag that traders should watch out for? For example, inflation showing up before, data. So how can traders watch out for this lag?
Yes, for example, you can monitor both CPI and both employment data and GDP. GDP is a lagging indicator, but it is representative of the economic growth.
Yeah.
Inflation, for example, inflation this year was kind of persistent, so it was not going down, it was rather flat. According to the Bureau of Labor Statistics of the United States, it was flat, but at the same time, the GDP for the second quarter was relatively decent. It was pretty good, in fact. And that shows that the economy does not slip into the stagflation, at least the US economy.
Yeah.
So that's why that boosted actually the S&P 500 index because traders investors were positive about this situation. They say good GDP in combination with relatively high inflation. So that's not bad. So that's a normal thing. And jobs, by the way, were also pretty robust. Labor market was robust.
Okay, so the question is, are we in this stage? Are we stagflating right now?
Well, according to macroeconomic indicators, no, we are not in stagflation.
We're not.
Because GDP is pretty strong, labor market is resilient, though it was cooling down a little bit in the US. Prices are also moving down slowly, not that fast like the Fed would like it to be, but they were still moving down. So according to the situation, we are not in stagflation, and maybe the AI narrative helped the markets this year because there were a lot of spending, a lot of investments in the AI sector. It helped actually the economy to hold above water, to keep above water. So maybe that's why.
Okay, so let's suppose that we are in a stagflation environment, right? What are some tips that you can give to some traders when we are in this stagflating environment?
So I think that in this case, macroeconomics or the economic releases and the behavior of the markets is disrupted a little bit. For example, you might have weakening dollar and higher yields of government bonds at the same time. You might have the strong data released and declining S&P 500 index because the sentiment becomes negative. So everybody is reacting negatively on the relatively good corporate data, for example. And nobody is expecting the interest rate to go higher. So dollar is not gaining in the situation. And there might be sell-off in the bond market. So money is not going to bonds, even though yields are high in this case. So if you see this disruption, so maybe that might be the sign that maybe there's this kind of stagflation in the market. In this case particularly, you might not trade in this market like in a normal condition. So you need to discount that. You need to take this into consideration.
Yeah, because it's special environment. Rules does not apply like we're in a normal period, let's say.
You need to discount this context for your decisions.
Okay, so let's check on some charts. What do you think? Probably S&P 500 would be a good example.
Yeah, so speaking of S&Ps, it had bounced off in October. So volatility had spiked a little bit. It has a pretty aggressive red day, 2.5% or maybe more down. Basically, it's in an uptrend yet, so it has not broken anything. But you see that this reversal in April 17th, which was basically the beginning of the new wave of the bullish trend, represents the resilience of the economy. So all incoming data was perceived by the market as optimistic, as positive. So sentiment still remains positive. Market breadth is slightly maybe going down, but not that bad. So markets are still in a bullish mode. Maybe it's in some consolidation. That shows that the narrative and the sentiment in the market is rather optimistic right now. So the data is not perceived as signs of stagflation by the market, at least for now.
Okay. All right. Thank you very much, Stan, for providing your views.
Yeah. Thank you, Andreas.
Thanks for watching us and hopefully have a clearer picture on what stagflation is and how it affects markets. Remember to subscribe to our channel to get notified about our next episode on trader psychology.